The majority of traders fall short because they mistakenly believe that success in trading comes from being correct all the time. They think the goal is to uncover a perfect system that can predict the market with near-total precision. This mindset leads them to constantly switch between indicators and strategies, chasing an illusion of certainty that doesn't exist. However, elite traders, the top 1%, understand a deeper truth. Trading isn't about accuracy, it's about probability management. Once you truly grasp this concept, everything shifts. You no longer feel compelled to win every trade. A single loss no longer feels like evidence your entire system is broken. You begin thinking like the house in a casino, not a desperate gambler. Casinos don't panic when someone wins a hand of blackjack. Why? Because across thousands of hands, the odds lean in their favor. Top traders adopt this same mindset. The challenge is that while many traders understand this intellectually, a few actually apply it. They still internalize losses. They still get emotionally shaken when a trade setup doesn't pan out. They react impulsively, increasing position sizes after a win, or avoiding trades entirely after a loss. The probability mindset isn't just theoretical, it's emotional conditioning. Consider the case of a trader who, back in 2002, began with $10, 000, and a simple trend-following strategy. Statistically, and the system worked, it had a 55% win rate with a 1-2 risk-to-reward ratio. On paper, that was more than enough to succeed. But for his first year, he barely made progress. Why? Because each time he experienced a streak of 3 or 4 losses, he stopped trading, doubting his system, and, almost predictably, the trades he skipped next turned out to be major winners. He had the math on his side, but lacked the mental alignment to follow through. This is the pitfall that traps most traders. They treat each trade as a personal test. When it fails, they see it as a reflection of their worth or competence rather than as a statistical event. Top traders detach identity from outcome. A losing trade doesn't mean they're a failure. It's just one instance in a long-term strategy. Imagine betting on a coin that lands on heads 60% of the time. Even so, getting 5 tails in a row is entirely possible. That doesn't negate the edge. Over hundreds of tosses, the edge will show up. Trading operates under the same principle. The market is simply more layered than a coin toss. Probabilities are embedded within patterns, setups, and risk rules, not certainties. One of the most powerful mindset shifts you can make is accepting this. You can do everything by the book, perfect analysis, precise entry, tight risk control, and still lose a trade. That doesn't mean you are wrong. It just means the odds didn't play out in your favor this time. The top traders don't resist this truth. They embrace it. Take the 2015 Swiss franc event as an example. The market moved with such speed that many traders couldn't exit at their stop-loss levels. Some accounts were wiped out instantly, but those who had already factored in the possibility of extreme moves, who had kept risk low and respected the reality of uncertainty, were able to weather the storm. After major market shocks, some traders give up altogether, declaring the market too chaotic to be navigated. But the top 1% don't flinch. They're already aware that unpredictable events are part of the landscape, which is why they always manage risk, so that even a rare, extreme event won't take them out of the game. They don't need to recover dramatically. They absorb the loss, adjust, and continue forward. That's the essence of probability-based thinking. Preserve first, profit second. If your account is wiped out, your trading career ends. The most successful traders are laser-focused on one thing: staying in the game long enough for their statistical edge to play out. They trust that a solid system, combined with unwavering discipline, will produce gains over time, but only if they're still present to execute the next setup. The probability mindset also neutralizes the urge to get even. If you see each trade as an isolated event, There's no emotional baggage to carry from one to the next. You don't feel compelled to make back what you lost, because you understand that every trade stands alone. That's not a natural mindset, it's a trained one. Successful traders keep detailed logs of their trades, not just the outcomes, but whether they followed their plan. Their focus is execution, not outcome. And over time, a pattern emerges. The most consistent winners aren't the ones who predict price action with scary precision. They're the ones who apply their edge with relentless discipline, regardless of the outcome of the last trade. Ultimately, mastering this mindset is what sets the elite apart. Without it, traders are tossed around by emotion, excitement, and fear, frustration. But with it, they remain steady, knowing that a single trade is insignificant, while 1,000 well-executed trades define their success. The truth is, most trading systems work, at least in the right market conditions. What separates average traders from exceptional ones isn't the strategy, but the discipline to wait for those ideal conditions. Patience becomes a superpower. In fact, in trading, it's not just a virtue, it's a weapon. The top traders are like snipers. They can watch 10 enticing setups and take none of them if the criteria aren't met. They wait for the perfect alignment, then pull the trigger without hesitation. Contrast that with the average trader, who reacts emotionally, jumping into trades out of boredom or fear of missing out. That impulsive mindset is often what leads to disaster. Many traders don't fail because they lack knowledge. They fail because they can't sit still. They see a candle breakout or a news headline and feel compelled to act. The elite trader has rewired that impulse. They've trained themselves to wait, to observe, and to strike only when the odds are stacked in their favor. To the most disciplined traders, choosing not to trade is still an active decision. It's a deliberate choice to protect capital and maintain psychological stability. Take the example of the early 2000s. During the height of the dot-com boom, tech stocks were surging almost daily, and novice traders were doubling their capital in mere weeks. People were leaving secure jobs to trade full-time, convinced that this time would be different. But the elite traders recognized a bubble for what it was. They remained on the sidelines, even as others laughed at them for missing out. And when the bubble finally burst in 2000, wiping out nearly 80% of the Nasdaq's value, these patient traders stepped in. They acquired high-quality companies at massive discounts. They hadn't been distracted by the hype, and they didn't need to catch every rally. They understood that markets always offer a second chance to those who wait. Patience in trading isn't just about waiting for the market, it's also about waiting for yourself. If you've recently endured a string of losses, your judgment is compromised. If you've had a big win, overconfidence can cloud your thinking. The most successful traders understand that mindset is part of the setup. If you're not in a clear mental space, even the most technically sound setup can lead to poor execution. They'd rather pass on a trade than take it with the wrong emotional posture. This is why patience goes beyond market timing. It's about emotional timing too. During the 2011 European debt crisis, the euro was extremely volatile against the US dollar. Many traders tried to ride every move, assuming volatility would translate into easy profit, but they forgot that high volatility can also accelerate losses. The best traders stayed out of the chaos and waited for the market to stretch to extreme levels before stepping in. They weren't concerned about frequency. Some traded only once or twice per week. What mattered was entering with complete clarity and conviction when the setup met all their criteria. The truth is, most traders confuse patience with inactivity, and inactivity feels like failure in a results-driven world. But the most difficult and most valuable discipline in trading is often doing nothing. The market will constantly tease you with subpar setups and the illusion of urgency. A top trader doesn't measure progress by how many trades they take. but by the quality of their decisions over time. They understand that capital preservation comes before everything else. Without capital, you're out. Without patience, you won't preserve that capital. One trader I knew made nearly his entire annual profit from just a few trades, usually 4 or 5 per year. He waited for months for price to reach long-term levels of support or resistance, confirmed across multiple timeframes. He didn't stress about missing minor price swings. He understood that once the market aligned with his criteria, the move would be significant enough to be worth the wait. While others were grinding out dozens of trades, racking up fees and commissions, he remained patient, then captured substantial gains when the right setup finally arrived. His patience wasn't complacency. It was calculated discipline. Patience also transforms how losses are handled. An impulsive trader, after taking a hit, often rushes to recover. That's the breeding ground for revenge trades, one of the fastest paths to account destruction. In contrast, a top-tier trader views a loss as just a piece of data. They don't jump back into the market. They wait. They wait for the next setup where the odds are clearly tilted in their favor. They understand that haste ruins decision-making. Patience turns a setback into insight. Impatience turns it into catastrophe. A legendary example of this mindset is Jesse Livermore, a renowned trader from the early 20th century. He often stayed out of the market for extended periods, simply observing. When the environment matched his playbook, he'd take bold positions and hold them sometimes for weeks, even months. That's exactly how he amassed his fortune during the 1929 crash. While others panicked and traded out of fear, he executed his plan. 1. He had patiently waited years to apply. Patience is not passive, it's a form of precision. A trader operating at the highest level is always analyzing, refining, and staying mentally prepared. They're not idle during downtime. They're building game plans, studying scenarios, rehearsing entries and exits. So when the market aligns with their strategy, they move with full conviction. Most traders do the opposite. They act without preparation and hesitate at the moment of execution. Patience bridges the gap between preparation and action. And it works because it allows probabilities to compound in your favor. Every price movement in the market is a blend of randomness and structure. If you trade on the noise, you're gambling. If you wait for alignment between structure, context, and your system, you're trading with real advantage. The truth is, the market doesn't reward urgency in the long run, but it does reward those who wait for the perfect storm over and over again. That's why top traders don't shy away from boredom. They lean into it. Boredom acts as a buffer against impulsive decisions. It keeps them out of low-quality trades, and in the game for the long haul, mastering patience is an edge in itself. If you can do that, you're already ahead of the vast majority. The hard part isn't learning a new technical pattern or chasing the next hot indicator. It's rewiring your brain to delay gratification, to act less, but with more purpose, to be content with long periods of inactivity. If the market doesn't meet your criteria, once you internalize that waiting is winning, you stop chasing every flicker on the chart and start approaching the market like the professionals do. You start to understand that trading isn't a sprint, it's a never-ending marathon. And the trader who knows when to pause, conserve energy, and wait for ideal conditions will outlast the one who burns out trying to force every move. What sets the top 1% apart isn't just patience or discipline, it's their ability to lean into uncertainty with confidence. Markets are, by nature, unpredictable. No one, no matter how experienced, can forecast the future with total accuracy. Anyone claiming otherwise is either deceiving others or themselves. The elite trader accepts this truth and builds their entire strategy around it. They don't waste effort chasing certainty. Instead, they take full control of what they can, their risk exposure, while staying open to surprises, including losses. Most traders, however, to resist this truth, they want the market to behave in a predictable, structured way. They cling to the illusion of control because it feels safe, but when the market breaks the mold, they panic, doubling down, abandoning their strategy, or giving up entirely. The top-performing traders take a completely different path. They see uncertainty not as a danger, but as an opportunity-rich environment. Every unpredictable moment becomes a potential edge if they've managed their risk properly and maintained mental clarity. Look back at 2008. During the global financial collapse, prices shifted violently by the hour. Many traders froze, or worse, blew up their accounts, trying to anticipate every twist and turn. But some of the best performers thrived. They didn't pretend to have all the answers. Instead, they prepared for various outcomes and kept their position sizing modest enough that no single loss could destroy them. When the storm passed, they emerged with substantial gains, capitalizing on price swings that few saw coming. So, how do you stay sane in the face of uncertainty? The secret is shifting your mindset from predicting to managing probabilities. Instead of assuming the price will go up, top traders think, given these conditions, there's a 60% likelihood it'll rise and a 40% chance it'll fall. This mental shift sounds subtle, but it's transformational. It frees you from the pressure to be right on every trade and helps you accept losses as natural. Statistical events. One powerful example of this mindset occurred in 2015. When the Swiss National Bank unexpectedly removed its currency cap against the euro, the Swiss franc soared within minutes. Many traders who had treated the peg as a sure thing were wiped out instantly, but the professionals who acknowledged that no policy is ever guaranteed had already factored in the potential for chaos. They didn't predict the exact moment. They didn't need to. They simply managed risk in a way that allowed them to survive and adapt, even in the face of market-shaking surprises. Part of embracing uncertainty is having the strength to exit losing positions quickly. No strategy guarantees a win on every trade. The most elite traders understand that holding onto a trade purely out of hope or stubbornness is a fast track to ruin. Instead, they apply disciplined stop losses and mental control to cut off losses before they spiral. This mindset is challenging for most traders because it feels like surrender, but those at the top see cutting a loss as a strategic victory, one that protects their capital and emotional stability, allowing them to stay sharp for the next high-quality opportunity. Another critical strategy in uncertain markets is diversification. Conditions are always shifting. A method that thrives in trending markets might fall apart during consolidation phases. That's why elite traders don't depend on one approach or a single market. They build adaptable systems with multiple strategies, timeframes, and asset classes, allowing them to pivot quickly and respond effectively to change. Take the famous case of a legendary trader during the 1987 Black Monday collapse. He didn't forecast the crash's exact timing, but he closely tracked the signals and kept a flexible outlook. When volatility exploded, he shifted from cautious to aggressively shorting stocks. His precise risk management and quick decision-making showed that embracing uncertainty means being willing to shift your stance as new data emerges. FOMO. The fear of missing out is one of the toughest psychological traps for traders. In a fast-moving market, it's tempting to jump in just to avoid missing potential gains. But seasoned traders know that FOMO clouds judgment. They've trained themselves to separate from the emotional urge to be right or to profit immediately. They trust their edge, and if a setup doesn't meet their standards, they're okay missing it. That detachment lets them make decisions rooted in probability, not emotion. Uncertainty also forces a reality check around control. Many traders operate under the illusion that with enough effort and analysis, they can predict outcomes, but real professionals know the only thing they can reliably control is their risk. Through proper position sizing, protective stops, and defined limits, they ensure that no single loss or even a streak of losses can end their career. Shifting your focus from forecasting to risk management is what builds long-term resilience. Think back to the mid-1990s Asian financial crisis. Countless traders tried to call the market bottom while panic selling dominated. Many were crushed trying to bet against the trend. But the top traders didn't fight it. They managed risk carefully, waited for signs of stabilization, and entered only when conditions turned. They weren't trying to be perfect. They were focused on survival and precision. That's what allowed them to act decisively when the opportunity arrived while others were still guessing. And finally, one of the most powerful lessons from accepting uncertainty is this: steady, repeatable execution beats dramatic, high-risk bets. Top traders don't chase huge wins. They build consistent results. Rather than chasing huge profits, top traders focus on taking smaller, high-probability trades with clearly defined risk. They understand that most trades will result in modest gains or small losses, but over hundreds, even thousands of trades. That steady approach compounds. Trying to land massive wins with blind conviction is one of the fastest ways to fail. The top 1% understand this deeply, and they prioritize consistent, deliberate growth over reckless ambition. Back in 2013, when the cryptocurrency market was still new and wildly volatile, many traders rushed in, hoping to strike it rich overnight. The top traders approached it differently. They stepped in cautiously, risking only a small portion of capital, applying tight risk controls, and prioritizing education over immediate profits. When the market finally boomed years later, they were ready. Their disciplined approach preserved both capital and insight, giving them the foundation to profit responsibly. Mental resilience is another pillar of trading success. The market will push your limits. Losses are inevitable. Surprises will happen. The top traders don't try to avoid these challenges. They prepare for them mentally and emotionally. Their strength lies not in avoiding difficulty, but in handling it without falling apart. This emotional stability helps them stick to the plan and come back stronger after setbacks. In trading, the only certainty is uncertainty. Accepting this doesn't make the job easier, but it makes it more realistic. The elite trader's mindset is rooted in humility, flexibility, and risk management, not in the illusion of control. They know no one can predict the market perfectly, so instead of seeking certainty, they build robust systems that help them thrive even when chaos strikes. This framework becomes the foundation for reliable profits, long-term growth, and a career that lasts. At the heart of it all is discipline. It's the invisible force that transforms strategy into results. It's what keeps traders aligned when emotions scream at them to break their rules. Without discipline, even the most advanced tools and accurate analysis fall apart under pressure. Discipline isn't just rule following, it's a mindset. It's an unwavering commitment to your process. Regardless of market conditions, it means showing up consistently, executing your system as planned, not chasing revenge trades, or bending your rules to match emotional impulses. Top traders know that discipline isn't a decision you make once. It's a habit you build and reinforce every day. It starts with trust in your system, in your research, in your process. When you develop a trading method that has long-term positive expectancy, discipline means sticking with it, even when short-term outcomes are frustrating. The top 1% stay the course. They resist the urge to ditch their plan after a losing streak, or to dive into impulsive, high-risk trades that fall outside their framework. They understand that real profits are the result of consistency, not luck, and not emotion. And when it comes to risk, they never compromise. Not a single trade is worth jeopardizing the whole account. Discipline and emotional control. The bedrock of long-term trading success. At its core, elite trading is about preservation. The best traders treat their capital like their most precious resource because it is, no matter how attractive a setup may seem, they never over-leverage or stretch beyond what their strategy allows. This mindset grants them the longevity needed to capitalize on the compounding power of consistent, manageable gains. Just as vital is emotional control, fear, greed, impatience, and hope are the most dangerous adversaries of a disciplined trader. The top performers don't suppress these feelings, they recognize them, but they've trained themselves to remain steady and detached. Even during sharp market swings or periods of consecutive losses, this emotional control stems from a deep understanding. Trading is a long-term pursuit, not a shortcut to riches. Accepting losses with grace is another core element. The top 1% know that losing trades are part of the game. What separates them from the average trader is how they respond. Instead of allowing a loss to spiral into frustration or revenge trades, they use it as feedback. They learn, adjust, and move forward without emotional baggage. This ability to manage losses without unraveling emotionally is a mental edge that few possess. Patience also plays a pivotal role. In today's fast-paced world, most people are wired for instant results. But elite traders are patient tacticians. They wait for ideal setups where multiple factors align and never enter the market just to do something. Patience also means staying in a trade long enough for it to play out, instead of jumping out early from fear or excitement. With this approach, trading transforms from speculation into strategic execution. True discipline goes far beyond pulling the trigger on a trade. It shows up in daily routines and mental habits that build long-term consistency. The best traders are committed to ongoing education. They review trades analytically, document performance honestly, and continually fine-tune their approach. They understand that preparation and post-trade reflection are what support flawless execution under pressure. So what does discipline really look like? It's saying no to averaging down on a loser, even when you're tempted. It's honoring your stop-loss, even when your gut says the market might reverse. It's setting a cap on how many trades you'll take each day to avoid fatigue or emotional decisions. It's knowing when to walk away and reset, rather than forcing trades out of restlessness. These small decisions, repeated daily, create massive advantages over time. Discipline also means facing the truth about yourself. The top traders routinely evaluate their blind spots and biases with brutal honesty. They know when the market conditions no longer suit their strategy, and they have no problem stepping aside. They're willing to admit when they don't know something and are constantly seeking improvement. This self-awareness is foundational. It shields them from arrogance and prevents overconfidence from wiping out years of progress. The hardest part of discipline: it demands consistency and sacrifice. Even when temptation is everywhere, markets are built to provoke you with constant noise, instant réaction, and the illusion that you're always in control. The most successful traders proactively build mental safeguards to protect themselves from emotional and psychological pitfalls. They establish routines, set reminders, and surround themselves with systems that keep them aligned with their strategy. In the end, discipline isn't restriction, it's liberation. It frees you from emotional turmoil, impulsive trades, and the exhausting cycle of fear and false hope. It gives you the clarity to think objectively, the confidence to act with conviction, and the strength to stay committed, even when the market gets tough. Top traders don't aim to win every trade. Their goal is to win consistently over the long haul, and that can only be achieved through unwavering discipline. If your goal is to become part of that elite group, your first step is to prioritize discipline. Above all, create systems that reinforce it. develop routines that support it, and cultivate a mindset that honors it no matter what the market throws at you. Discipline may not be flashy or exciting, but it's the unshakable foundation of every successful trading career. If what you've read here helps solidify your understanding of how discipline drives real results in trading, stay tuned for more insights like these. I regularly share actionable techniques and mindset shifts designed to take your trading performance to the next level. Before you leave, I'd love to hear from you. What's the biggest challenge you face in staying disciplined with your trading? And how are you working to overcome it? Share your experience in the comments. I read them all and truly appreciate your stories.